The Plan tab is where you make a plan for your money. Start by setting a duration for your plan. It can be as short as 1 month or as long as a year. Most of the time, you're probably going to set a plan that lasts for 3 months or more. The idea is that you don't have to be perfectly on budget in any 1 month, because you can smooth out the inevitable ups and downs in income and spending over the course of a multi-month plan. Next, select the accounts you want to download your transactions from. If you don't see any accounts, it means you don't have any linked accounts set up in the Assets and Liabilities tool. While you don't have to download transactions, because you can always add them manually, downloading transactions is likely to make your life much easier. For your expected net income, set up an income source and amount for each of your sources of income. Remember, this is net income, the amount you actually collect in your bank account after taxes and other deductions are taken out. Also, if you regularly receive income from other sources outside of your normal earnings, for example, maybe gifts of money or random income from odd jobs, etc., you may want to set up a catch-all bucket and call it something like other income. Expected net savings is all about money you're socking away. Most people use this section to track money they are depositing directly into a dedicated savings account. Typically, this savings account acts as an emergency fund, or an account used to save for short and medium-term financial goals. However you use it, it's important to note that since Budget Planner focuses on after-tax income, the savings entered in this section should also be after tax. In other words, if you're putting money into an investment account with pre-tax dollars, for example, a 401k or similar account, you won't track that here. You can track that type of saving in the Retirement Planner tool. The last thing to set up is expected spending. To start, we recommend setting up a line item for each account you spend money from. For most people, this will be any credit cards or checking accounts they have. If your only goal is to ensure your income, saving, and spending is balanced, you won't need to set up anything else. However, and only if you want to, you can set up specific categories of spending you're interested in tracking. For example, if you have a goal to keep your dining out spending at a certain level, set that category up. Just remember, the more categories you set up, the more you'll have to update every month. You can also set up spending for more significant items you're saving for and plan to pay for by withdrawing savings. For example, this might be a new computer, new car, or other significant expense you don't purchase very frequently. These types of expenses, whether they're paid for from a savings, checking, or credit card account, are called savings withdrawals. To set up a savings withdrawal, add a new spending item row and check the box at the end of the row for savings withdrawal. Note, since savings withdrawals are paid for from previously saved income, they aren't included in the calculation for your average monthly spending. Finally, you can review Plan Balance Check. This section shows you if your plan is balanced. Put another way, it tells you if your expected income matches what you plan to save and spend. Of course, your plan doesn't have to be balanced. If you're not earning very much or in a period of drawing down your savings, you will have low income, low or no savings, and high spending relative to your income. But whatever the case, this visual will give you a clear-eyed picture of your plan for your cash flow.